Hi folks, David Waring here again from LearnBonds.com, and today we're going to talk about how to read a bond quote. There are three different ways you will see bond prices quoted, which are as a percentage of face value, by their yield, and as a spread against treasuries. Here's an overview of each method. Most bonds are sold in $1,000 denominations. If you buy 20 bonds, you are buying bonds with a face value at maturity of $20,000. For a variety of reasons, bonds trade at a discount or premium to their face value. You would expect that a bond that has a $15 premium to its face value to be quoted at $1,015 when you tried to buy it. This is generally not the case. Instead, the bond would be quoted at 101.5 or 101.5. Bonds are generally quoted as a percentage of face value. There are two different conventions used to describe percentages less than 1% in a bond quote. The first is stating the remainder as a decimal, which is fairly easy to understand. A bond selling at 101.125 would have a cost of $1,011.25 to buy. However, the remainder can also be expressed as a fraction. For example, treasury bonds are usually expressed in 30 seconds. The price of the bond can be expressed as 101 and an eighth or 101.4, where it's assumed the 4 means 4 30 seconds. Next is bond quotes expressed in terms of yield. What does it mean when the anchor on CNBC says the 2-year treasury jumped 8 basis points to 2.12% yield? Here's a breakdown. 2-year treasury. This describes the bond being traded. Jumped 8 basis points. In bond speak, a point is equal to 1%. A basis point is equal to 1/100th or 0.01%. With bonds, price and yield have an inverse relationship. So an increase in yield means the price of the bond is dropped. The 2.12% is the yield to maturity based on the current market price of the bond. By talking about yield instead of price, it's easier to compare different bonds. Yield takes into account both the coupon rate of the bond and its market price. As bonds have different coupon rates, just looking at the percentage change in price would be a misleading gauge of the buyer's potential return on the bond. A 1% price move for a bond with a low interest rate is far more significant than a 1% price move for a bond with a high interest rate. Lastly, bond quotes are expressed as a spread against treasuries. Professional traders of corporate bonds often talk about price in terms of the difference between the bond's yield and the yield of a treasury with a comparable maturity. If a professional trader is offering a corporate bond to another trader at plus 175 and the yield of the comparable treasury is 2%, the yield of the corporate bond would be 3.75%. That's our lesson for today. Please feel free to leave any comments or questions in the comments section below. For more great bond news and education, also be sure to visit us at LearnBonds.com, follow us on Twitter at LearnBonds, and like us on Facebook at Facebook.com/LearnBonds page. Thanks for watching.